Welcome back to Educator.com. Today we're going to go over fiscal policy and the multiplier. So let's dive straight into the material here. All right, in today's lesson overview, we're going to examine the nature of the multiplier, which shows how initial changes in spending lead to further changes. The idea that a dollar spent isn't going to total a dollar, but there's some kind of multiplier that takes place. We're going to examine the causes of that. We're going to introduce the aggregate consumption function, which shows how current disposable income affects spending. So, depending on your the marginal propensity to consume, that's going to affect how much you actually spend, and also depending on your income. We're going to review the determinants of investment spending and its impact on the economy. We're going to differentiate between the spending and tax multiplier. So what's better, lower tax rates or increased government spending? We're going to go ahead and examine that. And finally, we're going to examine how the multiplier effect is influenced by automatic stabilizers. So what automatic stabilizers make it such that, there's kind of balance in fiscal policy. So let's go ahead and jump into it. So we're going to look at the MPC and MPS, which stands for the marginal propensity to consume and the marginal propensity to save. All right, so when investment spending increases, there will be an increase in the income and the value of the aggregate output by the same amount. Okay, so when they're spending, it makes sense. It's someone else's income, and basically the whole idea is that it doesn't stop there. So when more money is spent into the economy, it adds to the output, but guess what? That output also is going to lead to income, and it's going to circulate right back. The question is to what extent? By how much is it going to go back into the economy? So an increase in the aggregate output leads to an increase in disposable income and to more consumer spending, which leads to increased output. However, how large is the total effect on aggregate output if we sum up all the rounds of spending increases? So if we keep on cycling it up, what is the total impact that $50 million invested into the economy is that going to create? And really, in order to answer that, you have to figure out what is this marginal propensity to consume. So what percentage of that income are individuals going to consume? Because if you get $100 and you save all of that, then there's not going to be any extra money floating in the economy. But if you spend all of it, then there's going to be other implications. So we're going to take a look at that. So the answer, it really depends on what economists call the marginal propensity to consume and the marginal propensity to save. So what your marginal propensity to consume and conversely the marginal propensity to save, that's really gonna determine how much money is multiplied into the economy. What is this multiplier effect here? So the MPC is a change in consumer spending or the change in disposable income over the change in disposable income. And the MPS is very simple. So the MPS equals 1 minus the MPC. So another way of looking at it is that MPC, or the marginal propensity to consume, plus the MPS, the marginal propensity to save, is always going to equal 1. So if you have $100 and you spend $70 of it and you save 30, then your marginal propensity to consume is 70%, and your marginal propensity to save is 30%. So that's kind of the model that we're going to work with here. So let's look at the marginal propensity to consume, because that's really what it is. The marginal propensity to save is just 1 minus the MPC, and so you can go either way on this, but we're going to look at what percentage of the money that people earn, what percentage are they going to actually spend of that. So the MPC, it's going to be a number between 0 and 1. So now, in theory, can you spend more than 1? Let's say you earn $100,000. Can your MPC be 1.2? I suppose theoretically it is possible. As a rule of thumb for an economy, that's probably not going to be the case. You make $100,000 and you're going to spend $120,000. It is possible, but it's generally not going to be the rule of thumb in an economy. You're going to spend within your means, between 0 to 1. Okay, so if consumers save all their money, the propensity to consume would be 0. So if they save all their money, the number would be 0, meaning that they're not spending any money. So the MPC, marginal propensity to consume, is 0%, hence 0. Now, if consumers spend all their money, the number would be 1, because you've spent all your money. You spent 100% of your money. So those are two extremes. So you spend 0% or you spend 100%. Okay, and again, the corresponding numbers would be 0 and 1. So save all money. And here it would be spend all money. Now, what's better? Is it better to save all your money, or is it better to spend all your money? Again, there's short-run consequences for both. Personally, if I were to advise my high school students, and let's say they got a job, I would say absolutely save all your money. That is great to do. You're gonna be flexible. Now, if the goal was to try to boost the aggregate demand, spend a lot of money, then maybe spending all your money is the best way, because the aggregate demand increases. And if everyone buys into this concept of spending, this is how an economy grows. Okay, according to Keynes, that you boost aggregate demand. Now, some people will laugh at the argument, but if you want to pass this AP macro exam, then you better learn the rules of Keynes. The reality is that usually the number is between 0 to 1, with industrialized countries having a higher number and developing countries with lower numbers. Now, this might seem a little bit counterintuitive, but the idea is that when you're dealing with small sums of money in less developed countries, there may be more pressure to save more of that. So they're gonna save more. And in industrialized countries, when you're dealing with larger sums of money, then they're going to spend more because they have expectations of getting more money. So the MPC might be a little bit higher in industrialized countries than in more developing countries. And that certainly is the case in the United States. Our marginal propensity to consume might be 70, 80%, even higher. Whereas in China, the marginal propensity to consume is closer to like maybe 30 or 40%. Maybe 50%, but the Chinese are saving about 50% of their income, whereas Americans are saving, less than 20% of their income. So, as a rule of thumb, that's generally what ends up working out. So let's say hypothetically that the MPC is 0.8, so 80% of the money is spent, 80% of your paycheck. What's the impact of the total aggregate spending if there's an increase of $50 million in spending? All right, so in order to do that, you gotta work with the equation and then figure out what the multiplier is, and then multiply that by the initial increase in spending here. So you gotta revisit the formula here. The total increase is going to equal 1 over 1 minus MPC times the initial increase. So this is what's referred to as the multiplier. Okay, so here's the spending multiplier. So once you figure out the spending multiplier, then it should be fairly easy. So the initial increase is $50 million. So let's say there's investment spending of $50 million, or the government injects $15 million in spending, then what's going to happen? Well, you have 1 divided by 1 minus MPC, which is 0.8. So 1 over 1.8 is going to be 1 over 0.2, and that equals 5 times 50 million. So your multiplier is 5. So the spending multiplier is going to be 5. You multiply that by 50 million, and an initial increase of $50 million in spending is going to yield a total increase of $250 million. So again, if the government wanted to increase spending by $250 million, then it might be a mistake to look at it as saying, let's inject $250 million. If you figure out the tax or if the spending multiplier is 5, then do an initial increase of $50 million, and that will generate $250 million in terms of increase of the GDP. So the multiplier effect, how does that work here, and what's the actual definition of this multiplier? effect. So multiplier effect is basically this autonomous change in aggregate spending. What that is an initial rise or fall in aggregate spending that is the cause, so that's the beginning, and not the result of a series of income and spending changes. So that is the first thing that happens. So that's the initial increase of $20 million in spending or initial decrease. Okay, so that was in the previous example is the number on the second part of it. Now the multiplier is the ratio of the total change in real GDP caused by an autonomous change in aggregate spending to the size of that autonomous change. Simply put, it's 1 over 1 minus MPC. So it bears worth rewriting as an equation. So the multiplier, let's call it the spending multiplier. Spending multiplier is the idea of 1 over 1 minus MPC. So whatever it is, you get 1 minus the MPC. You take 1 divided by it, and that's the amount of, that's the multiplier. Now, another way to rewrite this equation here is 1 over MPS, because we know that MPS equals 1 minus MPC. So MPS plus MPC equals 1. So this is basically saying the exact same thing, depending on how you want to look at it. Now, the size of the multiplier, it depends on the MPC. So the higher the MPC, there's more disposable income, and that gets recycled back into consumer spending. So hypothetically, let's say the MPC equals 0.9. Okay, that's a really high MPC. That means the consumers are spending 90% of their disposable income here. And so 1 over 1 minus 0.9, the multiplier here would be 1 over 0.1 equals 10. Okay. Now let's say a relatively low MPC, the more disposable income leaks out into savings. So let's say you have a very frugal economy, and what ends up happening is that people only spend, let's say, 0.2. So let's say MPC equals 0.2. So people only spend 20% of their money. So you have a lot of savers. I'll tell you this: a lot of the retail stores would be really frustrated with that economy because people are only spending 20% of their money. They're not opening up their wallets. 1 minus 0.2 is going to be equal 1 over 0.8. Now, if you break that down, it's going to be 0.5 over 0.4. So 5 over 4 equals 1.25. So you're not going to have the spending multiplier if people aren't spending their disposable income. So for some reason, the MPC is 0.2, then you might have a problem in trying to stimulate the economy. You're gonna see some issues with that. The consumption function is a way to figure out, what is the amount of disposable income that people are going to actually consume. So you can actually, depending on their income, and so it's a straight, it's a direct relationship, because as you make more money, you're going to spend more money on consumption purchases, but you're not going to spend all of it. It depends on what your marginal propensity to consume is. So the consumption function is an equation showing how an individual household's consumer spending changes with disposable income. Okay, so autonomous consumer spending would be the amount spent regardless of income. So let's say, hypothetically, I got fired from my teaching job, or for some reason I quit, I didn't work. The idea is that consumers are going to spend a certain amount, and it could be different. It could be 10,000, 20,000, be 5,000. There's a certain amount of spending that is not tied to income at all. So maybe it's a bare minimum requirements to live, or again, there's maybe you're drawing on savings, or you're taking out credit card loans, or whatever in order to survive. So there's a certain amount, autonomous amount, maybe 15,000, 20,000. And so that's what this A value represents here. You're going to spend regardless of what your income is. And this consumption function is basically saying the consumption is A plus MPC times YD. And so what MPC is we went over this, we've gone over this. MPC here is the marginal propensity to consume. So what percentage of money are you going to consume? Marginal propensity to consume. Now what does YD equal? So YD here equals the disposable income. So what percentage of your disposable income are you going to consume? And then you add that to a preset amount that you're already going to spend, and that's your consumption figure. So let's work out a very simple math problem. Again, the math that you're really going to have to accomplish on this AP macro exam is going to be somewhat minimal. You might have to do some simple addition, subtraction, multiplication, but the whole point isn't to bombard you with a bunch of mathematical data here. It's not a test of calculus, it's not a test of mathematics, it's a test of whether or not you understand these basic economic concepts here. So let's go ahead and take a look at that. So let's assume that A equals $20,000 and the MPC equals 0.6. So you're going to spend $20,000 no matter what your income. You don't make anything, or you make $20,000 a year, $15,000 a year. What would the consumption be if your Y value is $100,000 and also if it's $200,000? So again, let's just set up the equation here. C equals A plus MPC times YD. Okay, so we're trying to figure out what the consumption is. C equals, that's 20,000 plus 0.6, and then let's plug in that $100,000 first. And so equals $20,000 plus 0.6 of $100,000 equals $60,000. And your consumption is going to be $80,000. So what your consumption is, if you're making $100,000 and your marginal propensity to consume is 0.6 and your autonomous consumption is $20,000, then you're going to spend $80,000. Now, what happens if your income is $200,000? Well, again, you still use that same income here, or the same equation here. C equals A plus MPC times disposable income. And you get C equals, again, you're going to spend that $20,000 no matter what, 0.6. And now you multiply by $200,000 instead of the $100,000. So you have the $20,000 plus 60% of $200,000 is going to be 60% is going to be $120,000. So you can add that to $20,000 and you're going to spend $140,000. So you have $60,000 left over here. You only have $20,000 here. So percentage-wise of your income, the more money that you make, you're actually going to save more because you're not dealing with that autonomous amount that you're going to spend. So here, again, obviously you have more income here, but you save $20,000 right here. Right here, you save from your $200,000 income. There's $60,000 that you've saved. So you've actually saved at a greater percentage of your income. So let's take a look. How's it going to look on a graph? CF1 equals $20,000 plus 0.6 YD. So let's label this as YD, or this is your disposable income. And here's the consumption function here, or this is your consumption here. So let's go ahead and draw this here like this. It's going to be a graph like this. What is this going to be here? If your disposable income is 0, then your consumption is 20,000. Okay. So again, let's throw in the numbers that we did. 100,000 is going to equal 80,000 here. So again, this is probably not the greatest to scale here. Let's just assume that it is here. I didn't do the best job of putting this to scale. But let's say this is 100,000. So the income is $100,000. And let's say that this here is going to be $100,000. This is $80,000. And then $200,000. So let's say this is 200K. And I didn't do it. Lines are not the straightest right here. It's okay. And let's say this is $200,000, and now you get $140,000. So again, what you have here is you have a bunch of data points, and you're trying to find the line of best fit. So, obviously there's different, line of best fit. If you're familiar with statistics, if you're also taking AP statistics, then, there are different formulas that you could use to try to find the line of best fit. But basically, when you have data of 1,000 people that make different amounts of income, you can maybe see a certain pattern, and that's where you come up with this autonomous consumption, right? And so what you'd probably have is something like this to give you the correlation between income and disposable income and consumption. Now, you might have this one outlier here or one outlier here, but most of your data points are going to be kind of following this trend here. So what would this outlier mean? This outlier would mean that a person is only making $80,000 but spending like crazy. That definitely is possible. Or you may have clearly Warren Buffett makes a lot more money than this, but maybe here you make tons of money, but you're just not spending a whole lot. And if you don't make any money at all, but for some reason, let's say you have good credit and you just spend a lot of money. So there's going to be outliers. Okay, there's going to be people like that, but for the most part, you're going to see a notable pattern or trend in the relationship between disposable income and consumption. So how does this aggregate consumption function, how's it going to shift here? And so you can see here two ways that you're going to see the aggregate consumption function shift. It's changes in expected future disposable income. So let's say you're at a job and you expect to get a promotion. You didn't get the promotion, but changes in expected future disposable income is going to increase your consumption function. So the idea is that let's say you elevate to a higher level of wealth or a higher level of yearly income, then you're probably gonna think richer than you actually are. And so that's going to change the entire consumption function. Or a change in aggregate wealth. So here it has to do with income. The second point is the idea of you're actually richer. Maybe there's a boom in the stock market, or the value of home prices went up here. Okay, so if you land a higher paying job, you will tend to consume more money now, even though your current income stays the same. So you landed the high paying job, but the promotion doesn't take into effect until maybe 5-6 months from now. You still might buy that refrigerator that you're holding off on, because psychologically now you might be better off. Conversely, if you're worried about a job layoff, you'll probably decrease your current expense. So let's say instead of getting a promotion, there's a round of layoffs that's announced. You're fearful that you might get downsized. Then chances are you're not going to buy that refrigerator. You're probably going to withhold making a lot of purchases. You might not go on that vacation to Greece that your family was planning on going to. Another way that the consumption function can either shift up or down is changes in aggregate wealth. So a booming stock market will tend to increase an individual's wealth, and therefore his consumption. So if you're literally more wealthy, you have more assets, then the consumption function is going to increase. Conversely, a fall in housing prices, will tend to decrease an individual's net worth, and therefore her consumption. So if you have a $450,000 house and the housing market collapses, which it did in 2007, 2008, and now your house is only worth $250,000. Well, you're less wealthy, and so the consumption of items, it might actually decrease. So you might have a shift downwards of your consumption function. Okay, so investment spending. We'll take another look at the investment side rather than the consumption side here. Planned investment spending is investment spending that businesses intend, and that's kind of the key word, because businesses aren't perfect. They can't exactly figure out how much they're going to spend. Intend to undertake during a given time period. So, for example, if interest rates go up, less investment spending occurs. Conversely, if interest rates go down, there's more investment spending. Businesses would much rather prefer interest rates at 3% than 5%. 5% means that it's more expensive to borrow, and the costs of doing business are higher. At 3%, then doing a project might seem a little bit more useful than if it was at 5%. High expected future growth rate of GDP increases investment, and conversely, low expected future growth rate decreases investment. Okay, and when you're looking at this situation here, so investment can equal there's unplanned and there's planned inventory investment. You will have positive unplanned inventory investment. That's going to occur when sales are less than business expects. So if you have a lot of inventory, it's probably not a good sign, because then you've overproduced. So if you have positive unplanned inventory, that means sales are generally sluggish here. Conversely, excess sales is going to lead to negative unplanned inventory investment. So if the unplanned inventory is negative, that means that there's probably a shortage, which means that sales were higher than you had expected. You only planned to have 500 cars sold, but you sold 1,000, so the unplanned inventory would be negative 500. Whereas if you plan to sell 2,000 cars and you only sell one car, then you have an excess inventory of 1,999. So if you have rising inventory, that usually indicates a slowing economy. If you have lowering inventory levels, then conversely, that's going to be a sign of a growing economy. So let's take a look at this tax or government multiplier. So the tax or government transfer multiplier here, and then we'll compare that to the spending multiplier, which we've gone over. And again, there's a formula that's relevant to the tax or government transfer multiplier, and there's the spending multiplier here. So basically what's going on here, changes in taxes or increase in tax repayments. So again, for the effects of a tax multiplier, basically going to have the same effect. It's going to shift the aggregate demand curve by less than an equal size change in government purchases. So what's the most effective means to stimulate the economy? It's an increase in government purchases. That's going to have a more of a direct impact than an increase in government transfers or a decrease in the tax rate here. And so let's go ahead and take a look here. So the effect on the real GDP, if the government, if they step in and spend $100 billion in government purchases, in the first round, there's $100 billion. There you go. Here's $100 billion. And literally, there's $100 billion that's spent. Well, of that, if the multiplier is 2, then the second round, there's going to be $50 billion that's spent. And then the third round, there's going to be $25 billion spent. What ends up happening is that it's halved every time. So the next round is going to be 12.5, 6.25, 3.125, and so on and so forth. And the total effect is going to be $200 billion that's injected into the economy. $200 billion. And let's cross-reference that with the formula here. And so you have the total increase. You're trying to figure that out. 1 over 1 minus MPC. Now, I didn't tell you what the MPC is, but you can figure out because the multiplier is 2. 1 over 1 minus 0.5 is going to equal 0.5 times the increase, which is $100 billion. And so you have a situation with 2 times 100 billion equals 200 billion. So the increase using the government multiplier or the spending multiplier, then you get a total increase of $200 billion into the economy. Now the tax multiplier or the government transfer multiplier is going to be the exact same thing, except you take out this first round here. So that first round of that $100 billion, it doesn't exist. And the way that you can actually capture it in the equation is instead of multiplying by 1 over 1 minus MPC here. So here, this formula here is 1 over 1 minus MPC. And so this is the spending multiplier. Here, the correct multiplier to use is MPC over 1 minus MPC. And so let's call this the tax multiplier. So we determined here that the multiplier is 2. The multiplier is 2, and so the MPC was actually 0.5 here. So let's multiply 0.5 divided by 1 minus 0.5, and that one's really easy. Now it equals 1, and times $100 billion. What impact is it going to have? It's going to have $100 billion impact. Okay. Again, the reason why is if you cut taxes by $100 billion, or if you increase unemployment benefits by $100 billion, well, people are going to spend 50% of that. And then of that amount, they're going to spend 50% of that. Of that amount, they're going to spend 50% of that. And so if you add this total round together, when you put $100 billion into the economy, you're going to have a total of $100 billion spent if you're spending multipliers too. Because if you use the tax multiplier, which is MPC over 1 minus MPC, you're not going to get as much direct impact onto the economy, because money is going to leak out through the saving process here. Okay. Now, automatic stabilizers. Why is that important when you're dealing with government spending and taxation? Well, government spending and taxation rules that cause fiscal policy to be automatically expansionary when the economy contracts, and automatically contractionary when the economy expands. So let me explain that. So there's nothing that is set into law, set into place. These are just natural rules, natural byproducts of what happens in a recessionary or inflationary times. So as the economy expands, the multiplier reduces. It's going to reduce because the increase in income is siphoned off through increases in taxes. So this multiplier, people aren't going to spend as much money, because as income increases, what's going to happen is that with a progressively higher tax rate, there's going to be more taxes that are taken out, and so the multiplier is going to actually be reduced. So the spending multiplier is going to be the amount of money that's circulating in the economy is actually going to be reduced because of the increase in the tax rate. Now, conversely, as the economy contracts, the multiplier increases because the government is collecting less in taxes, which is a de facto expansionary policy in the face of recession. So what's going to end up happening is that you have a recession, so people aren't doing well. So there's going to be an increase in government transfers, right? So what's going to end up happening is that people get more unemployment benefits. That's a huge boost to the economy. So in bad times, a lot of expansionary fiscal policy measures will kick in. That's going to boost the economy when we're in a recession. Now, in 2008, the Great Recession of 2008, the government responded with some fiscal policy measures. Now, early on, when before Lehman Brothers and Bear Stearns had collapsed, there was still talks that the economy might not be doing too well. So in early 2008, again before the collapse of the stock market, there's signs that the economy was kind of slowing. So the question on the horizon was whether tax cuts or transfer payments would be used. It wasn't politically feasible, even though it's technically going to stimulate the economy more when there's government spending. What's economically in the best interest might not necessarily be in the political best interest. There's a lot of hesitancy to increase our already increasing government budget deficit and government debt. So in early 2008, the question was, do we lower tax cuts or do we increase transfer budgets? Obviously, it's gonna put a dent into our budgetary process. But politically speaking, people like getting money back rather than the idea of the government spending. So this is what initially happened here. Taxpayers are giving a flat $600 rebate or $1,200 for married couples. It's a nice boost on your tax return. You reduce your tax liability, but it only occurred for those below a certain income threshold. And again, the macro reasoning for that is that if you give Bill Gates, if you give Clayton Kershaw, someone who makes tons of money, an extra $1,200 or an extra $600, they're not going to spend it. They're just going to save it, right? So those with lower incomes will tend to spend more of their income. So that was the reasoning behind, maybe aside from the fairness argument. Or $300 for those who didn't pay income taxes. So not only was there a tax reduction of $600 or $1,200, a flat tax reduction, there was a $300 rebate for those that didn't even pay. So it's a $300 credit. So that actually counts as more of a transfer payment. You're transferring wealth, or basically you can look at it as a tax cut. So tax cuts and transfer payments work in the same way. So the choice initially was this combination of tax cuts, a very conventional way, and transfer payments. Again, the idea of giving income tax refunds to those that never even earned it, it's more of a transfer payment. It's not actually a tax cut. Well, it didn't necessarily work. A lot of different things going on in the economy, and a lot of economists would say that wasn't enough to help out the American people. So finally, in February 2009, so after Obama has been elected President of the United States, Congress passed the American Recovery and Reinvestment Act, which was a $787 billion stimulus package. So what it did was there was help for unemployed, Medicaid spending, and food stamps. So there was a direct injection of money into the economy. There was investments in infrastructure, energy, healthcare, and in addition to government spending, there's tax cuts for families and small businesses. So the government, one thing you can't really accuse the government of doing that maybe during the Great Depression, there are a lot of measures that were taking place. Now, were all the measures effective? Would it have been wise to maybe focus more on investments in infrastructure rather than some other expenses that might not have yielded as much fruit? Probably, but the idea of using expansionary fiscal policy was something that the president and Congress, there's a lot of political pressure to do. And again, whether or not it actually worked or not, whether it would have been better to just cut government spending and cut taxes, have more of a balanced approach. The problem is that you might be making the recession worse by trying to balance the budget. So the number one priority, at least for the Obama administration and Congress at the time, no matter what your politics were, was to use whatever expansionary fiscal policy measure in order to save the economy. Again, it may take years to sort out what worked and what didn't, but you could see the reasoning behind why you would cut taxes, but also spend on infrastructure, unemployed, food stamps, unemployment, because of this idea of stimulating the economy and the multiplier effect. So let's take example number one here. If the consumption function is C equals 15,000 plus 0.8 YD, draw a correctly labeled graph showing this consumption function. What would happen if expected future income decreased here? So let's take a look here at this y-axis is consumption here, the y-axis, and the x-axis would be YD here. Now, 15,000 represents the autonomous consumption here. So no matter what, there's going to be $15,000 spent here. So let's go ahead and go in increments. Let's label this graph here. So this is 5K, 10K, 15K. That's what we got right here. 20K, 25K, 30K. And this is a stop at 35K. So basically what's going on is that no matter what, you're going to spend $15,000 no matter what your income. There's no relationship. That's the constant here. So let's say your income is $10,000. Okay, so you have 0 right here. You have, let's go in increments of 10, 20, 30. So if your income is 10K, 20K, and 30K. Okay, so you might want to use a little more numbers that will actually fit on this graph here. Let's say 5K, 10K, and 15K here. So if you're making $5,000, 5,000 times 0.8, so 80% of $5,000 would be 4,000, so it'd be $19,000, so somewhere right here. A little shade under $20,000. You make $10,000, 10,000, 80% of that is 8,000 plus 15,000 would be 23,000. And 15,000, if you make $15,000, 8% of 80% of 15,000 would be 12,000 plus 15,000, 27,000. So your consumption function would look a little like this. This would be CF1 here. Now, what would happen if expected future income decreased here? Then what would happen is that if your expected future income decreases here, then your consumption function is also going to decrease as well. So you have CF2 right here. So maybe your autonomous consumption function is going to drop down to 10,000 to kind of adjust for this decrease in future income. So example number 2 here. Changes in which of the following leads to a shift in the aggregate consumption function? So what's going to cause there to be an increase or decrease in the aggregate consumption function? Will expected future disposable income, is that going to change the aggregate consumption function? Absolutely. So expect more money in the future, it's going to change the overall behavior. What about your aggregate wealth? Absolutely, once again. So if you're richer, then the consumption function is going to increase. If you're poorer, you lose your house, then it's going to decrease the consumption function. Okay. What about current disposable income? Sounds like it might be correct, but what's going to happen, it's not going to change the consumption function. It's just going to be a change in within the same function. So this is actually incorrect here. So the answer is 1 and 2. This is incorrect, 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 incorrect. And so the correct answer is D. You know, for these, once you find the correct answer, you can circle it. But, you know, sometimes I want to make sure that each of these answers are incorrect before marking the correct answer. Okay, example number 3. The presence of taxes has what effect on the multiplier? Does it increase the effect of the multiplier? It actually does not. Okay, it does not increase it. Does it decrease it? It does, so I want to make sure this seems like the correct answer. Does it destabilize it? No. Does it negate it? No. Does it have no effect on it? No. So basically, when you have higher taxes, the multiplier, it's going to decrease the impact of the multiplier. And finally, the final example here. Again, let's work with some very simple maths, but being able to organize all this information that we've introduced today, organize it in a way that you can actually use simple numbers to get the figure that you want here. Assume that the MPC in the economy is 0.8. So the economy is spending 80% of their money, and the government increases spending by $50 million, which is definitely something that is going to help the economy. Okay, from a stimulus standpoint here. Assume that there are no taxes, exports or imports, and changes in the aggregate price level. So everything else is constant. The only thing that's changed is that there's an influx of $50 million into the economy. Okay, for the first question is, what's the value of the multiplier? Well, the value of the multiplier, remember, the value of the multiplier for increase in spending, so the spending multiplier is going to be 1 over 1 minus MPC. And we know the MPC is 0.8. 1 over 1 minus 0.8 equals 1 over 0.2 equals 5. The multiplier is 5. Okay, so again, very simple math here. And let's try another simple math problem using this multiplier here. So by how much will the real GDP change by? Okay, so the change in real GDP is going to equal the multiplier times initial change. And what did you have here? Well, the multiplier was 5. 1 over 1 minus MPC times 50 million. And ladies and gentlemen, a $50 million injection in spending is going to have an impact of $250 million positive impact on the GDP here. Whereas if there's a cut in government spending by $50 million, the GDP might reduce by $250 million. Thanks for watching Educator.com.